Is Huntsville, Alabama in a housing bubble? Is your equity all gonna disappear? Is this bubble about to pop? I'm gonna dive into the underlying economic numbers and try to figure out where we are. Hey guys, my name is Brandon Taylor with Capstone Realty. Hope you're doing great today. I had a question over on my Instagram the other day. By the way, follow if you are not currently following. Give me a little follow over there. I try to put some good content that's engaging on the Huntsville real estate market, as well as housing pictures and all that kind of stuff. So, and I do walk through Wednesday over there every week. So follow along over there. I also am on Facebook and YouTube. So you'll be watching this on one of those three probably. And join me on the other ones. Anyway, so I asked over there if people thought that we were in a housing bubble. And something like 2/3 of people said that they think we are. And so I thought today I would address the question of what is a housing bubble and is Huntsville's real estate market in one now? That's what we're gonna look at. The first question we have to answer is, what is a housing bubble? We all know what a bubble is, something full of air, no substance, and then it pops someday. We always think of things like the Great Depression, what happened in 2008, the dot-com bubble, all these times in history when the economy was really brought down in a broad base by bubbles popping. In general, there are two kinds of bubbles. There are equity bubbles and debt bubbles. Equity bubbles are like what happened in 2001, where the prices of the dot-com companies were overinflated, or if you look back to the tulips back in the Dutch in the 1600s, those are equity bubbles, where a company is just overvalued by the market, and then it pops and that company goes to zero, and they take some people's money and wealth with them. The other kind of bubble is a debt bubble. These are normally farther reaching. Things like what happened in 2008 was a debt bubble. What happened in the Great Depression was a debt bubble. Some things that have happened in Australia right now and in Japan in the late 80s, those are debt bubbles as well. And those tend to have farther reaching consequences because they often take the whole banking system with them. Those are the two kinds of bubbles that exist. Now let's talk about what the criteria for a bubble is. So I did some reading. I'm no economist. I don't claim to be, but from my armchair economist perspective, it seems like there are four criteria for something to be considered a bubble. And that is rapidly increasing prices, exuberance in the market, unsupported by the fundamentals of the asset, and then something that pops it at the end. So those are the four things we're looking at and trying to check and see if the Huntsville real estate market is in that situation. I think the first two criteria, the rising prices and the exuberance, are both pretty easy for us to say, yeah, we are in that situation. Rising prices across the Valley MLS were something like 22% in the last 12 months for the median price going up. Some markets are even higher than that when you think of lower price markets. Madison County is at like 12%, but a couple months ago it was 16%. So that's definitely within the definition of rapidly rising prices. When you think historically, prices increase about 4% a year on housing, 3 to 4%. And that's healthy. So rapidly increasing prices, check. All right, so the last two are the ones we're gonna spend most of our time on. First off, are these price increases supported by the fundamentals? And what would it have to look like for these prices to pop for something to change? Home evaluation is based on comparable sales. Personally owned real estate does not create income, so we don't do multiples of income. We do it based on what others sell. So it's strictly a supply and demand kind of market. And supply and demand are pretty easy to look back on. And so we're gonna dive into some numbers that I think show what the fundamentals of the market are that are causing the price increases. So the first fundamental I want to look at is what I'm calling this total inventory chart. So what this chart looks at is we see at the bottom how many sold each month, and I've got 12-month moving average, so it smooths it out a little bit so we can see the direction of that demand line. The top line is the inventory, or the supply of houses that we have since January 2004. There was a change in how the MLS has reported data, so that's why we started in 2004 and not earlier, but yeah, I think it's pretty useful. So there's a couple things I want to point out here that I think are interesting. I think there's a few dates that are pretty interesting. So you can notice from 2005 until about 2010, we see that the demand has a gradual decrease. So it's a low slope, not anything significant, but a gradual decrease. And just that gradual decrease meets up to a very significant increase in inventory. So I thought that was interesting until 2010. So that, of course, was when we were having our financial crisis as a country and world, really. And so that lines up with that, with the low of inventory was in 2005,
which was kind of the peak of housing boom nationwide, including in our market. Then inventory gradually increased. Anyway, and so then the demand stayed just basically steady. And so did inventory from 2010 until 2015. And then we see a significant inflection point, I feel like, in January of 2015, both on the inventory, where it changes direction. From 2015 until 2020, there's a steady decrease in the amount of inventory we have. And there's also a steady increase in the demand we have. And let's look at the price chart. The price chart, very similar shapes, right? We had a gradual increase in price up till 2010. And then from 2010 until 2015, we had it flat. And then from 2015 till 2020, it increased in price steadily. So I think we see that there's a correlation there. But is there causation? I say yes. Hey, I was editing this video and I noticed something that I wanted to point out. I thought it might be pointed out to me if I don't. So why does the price continue to go up from 2005 to 2010, even though we're having an increase in inventory? Is the question I wanted to answer real quick. Basically because when we're in a seller's market, which is anything below about 5 months worth of inventory, the prices are going to continue to appreciate. And so the whole time from 2005 up until probably 2008 or so, when you start seeing that curve of price slow down, we're still in a seller's market. Back to your regularly scheduled video. All right, so the last chart I want to look at is this labor force chart. It has a very interesting thing happening. So if you look at the labor force chart from 2005 till 2010, we have a steady increase in the labor force with a little blip there in the middle towards 2008, 2009. But it's a steady increase until about 2010. 2010 to 2015 stays very steady. 2015 to 2020, we have an inflection point early in 2015, and that goes all the way until basically the beginning of 2020. So I see correlation, possibly causation. So if we look back in time to news a little bit, 2013 through 2015, there were a bunch of positive economic development news that came to Huntsville. So that included the Remington plant, the Polaris plant, and a GE plant in 2014 and 15. And those things started hiring then. And since then, we've had a lot more with Facebook and Google and the Toyota plant and a bunch of programs on the arsenal that are growing, and continued expansion with the FBI and all those things. It's been a bonanza since then, but that was the start. And so that was what drove our inflection point in 2015. Now, does this justify the current thing that's going on? I think it does. When we look back at our inventory chart, we see that we've really been on a collision course where our supply was not going to keep up for our demand for like 5 years. And even though the demand has ticked up a little bit, if it had stayed steady, we would be in the same problem. So what it boils down to is we've had a growth in the workforce without enough growth in the number of houses. So we've had a supply constraint and demand increasing, and that has been going on for 5 years. And now we're seeing as those things get closer together, the rate of increase for prices increases. So that rate goes up. We see what's happening now, where it sure feels like a bubble. But one other thing is, in order for it to be a bubble, something has to be able to pop it. So what would pop it? What would have to change for prices to really correct? So for it to be a debt bubble, which I would think it would have to be, two things would have to happen. It would have to be poor buyer qualification, and their ability, so that they would not have ability to repay, and the underlying asset would both have to go down in value at the same time. So is that happening? I think no, and we can look at why deeper maybe next time. The short answer is that the lending standards were changed in 2008, and they were very tightened up for a while, but lenders haven't really relaxed those. The people who are winning these bidding wars now are winning because they're putting a lot of cash and significant down payments into the homes. And so they're very well qualified. They aren't risky buyers per se. In fact, the riskiest buyers in this market really aren't able to get homes as easily. So it doesn't seem like we're taking on kind of that systematic risk that we heard so much about in 2008. And the driver of the growth is fundamental population growth. So that is a fundamental that is supporting the number. So I don't think we're in a bubble. I think the numbers support it. What do you think? Is there something I'm missing? If so, what? What am I not looking at? So it doesn't seem like people are overextended. It doesn't seem like we're lowering lending standards. So it doesn't seem like we're taking on risk. It seems like the prices are just going up.